Welcome to Breaking News to Trading Moves. Today, we're looking at some pretty striking market events in the European electric vehicle space. Specifically, we've got performance data out of Europe, Germany in particular, for October 2025. And it shows a real contradiction. The headline is this: the overall EV market in Germany was growing quite well, but one major global player saw its registrations fall off a cliff. It doesn't look like a general EV problem, more like a specific company issue, wouldn't you say?
That's exactly right. And that's what we need to get into. Our job today is to look at those European numbers, see which U.S.-listed companies are actually benefiting from this. Well, this change in buyer preference. And just as importantly, which companies might be feeling the pressure because of it.
Okay, let's dive straight into that headline number then, the big drop. What exactly did the October 2025 data show for Tesla in Germany?
That's a pretty stark figure. Tesla's registrations in Germany, they fell 53.5% compared to the year before. That brought their October volume down to only 750 units, just 750. And this wasn't just Germany. We saw reports of similar weakness, renewed declines in October, across several other key European markets, too.
Wow, okay, a 53.5% drop in Germany alone is certainly going to get attention. But the big question is why, right? Is the whole market weak, or is this...
That's the absolutely critical piece of context here. This drop happened while the overall market for battery electric vehicles, BEVs, in Germany actually saw strong growth. So no, it's not the market itself cooling off. It seems very specific to Tesla losing ground there. As for the why, well, it's likely a few things coming together. You've got some natural sales timing lumpiness, maybe. Tesla often pushes hard end of quarter. October can be slower after a Q3 push, but maybe not this slow usually. The bigger factor seems to be local competition really heating up. New models from established European brands are hitting the market. Plus, changes to some German purchase subsidies might have affected the premium end, where Tesla plays, more than other segments. So, yeah, probably a mix of timing and real competitive heat.
Okay, that makes sense. If Tesla's losing share but the overall BEV market is growing, then someone has to be picking up those sales. Who are the winners among the U.S.-listed companies? Let's start with the legacy automakers.
Yeah, absolutely. First place to look is U.S. legacy companies with a solid European presence and, crucially, EV alternatives on sale right now. Think about Ford, ticker F. Their Mustang Mach-E, the electric transit vans, they compete directly in some of these volume segments. When you see Tesla stumble like this in the EU, shoppers might just, lean towards Ford. Familiar brand, dealer network already there. Same logic applies to General Motors, GM. They've got their export plans, partnerships in place, and their EV lineup is improving. They're positioned to grab some of that spillover, especially in the popular electric SUV space in Europe.
And you flagged Stellantis, too, ticker STLA. They're listed in New York, but obviously have huge European roots. Peugeot, Opel, Fiat.
Exactly. Stellantis is a big one here. They already have the scale, the dealers, everything in Europe. So if Tesla looks weaker, the competitive landscape just gets, a bit easier for Stellantis and their pretty broad EV range. They have options across different price points, and maybe, just maybe, it gives them a little more flexibility on pricing.
On the pricing power point, though, are we sure a 50% drop for one competitor automatically gives Stellantis pricing power? Or is it more that investors just feel relieved that Tesla isn't running away with the market?
That's a fair point. It's definitely partly relief, no doubt, but the pricing aspect isn't necessarily about hiking prices up. It's more about not having to discount aggressively. Think about it. If Tesla felt forced to slash prices in Europe to win back share, which they might, right? Stellantis, with its established brands and wide range, might be better able to hold its current price levels compared to a situation where Tesla was still rapidly expanding. So it's more like a defensive pricing advantage, maybe?
Okay, I see that framing. Avoiding a price war is definitely a win. What about the U.S.-listed pure EV companies, the challengers? How do they benefit?
Yeah, for them, it's often less about grabbing huge sales volumes immediately and more about how investors see things. The narrative, take Rivian, R-I-V-N, their premium adventure vehicles, they kind of stand out more when the sort of mainstream premium EV leader, Tesla, cools off. This German data helps make the case that the EV future isn't just about one company, right? Which is good for the story around these non-Tesla growth names. And then you have Lucid, LCID. Luxury buyers may be looking for something different, perhaps put off by some of the Tesla brand noise. They might give Lucid another look. Any hint of more European interest for them, or even talk of potential partnerships over there, tends to give their stock multiple a bit of a boost.
So the challengers get a bit of a spotlight shown on them. Just the fact that the dominant player shows weakness in a key region makes these other pure-play EV companies look relatively more appealing, even if their European sales are still small right now. Sort of psychological winners. That's a good way to put it. And don't forget the big diversified auto groups listed in the U.S., often as ADRs. They also see some tailwinds. Honda, for example, ticker HMC. They have new models coming, strategic partnerships. They could benefit if European buyers decide maybe they don't want to be locked into just one EV brand's ecosystem. Toyota too, TM. Okay, they've been more hybrid-focused historically, but they are expanding their BEV and plug-in hybrid offerings. So when the leading premium EV brand has a tough month or quarter in a place like Germany, it just creates more space for Toyota's electrified options. Right, so for all these winners, the legacies, the challengers, the diversified giants, the common theme is that having broader portfolios, different brands, different price points, allows them to pick up demand when one big player falters regionally. Okay, let's flip the coin. Where's the pressure being felt most acutely? Obviously, starting with Tesla itself.
Yeah, the direct consequences are clear for Tesla, TSLA. The German sales slide, potentially broader EU weakness. That's a direct hit to their volume. And with DIGA Berlin, right there in Germany, a 53.5% drop. Well, it raises immediate questions about factory utilization. That's never good for the margin story. High fixed costs need high volume. And the pressure goes beyond just Tesla cars. Think about the charging infrastructure. ChargePoint, CHPT, and Blink Charging, BLNK, both have operations in Europe. If there are fewer new Teslas hitting the roads in key European areas, that means less traffic for high-visibility charging stations. It kind of dampens the immediate excitement about charging network usage growth, stalls those utilization forecasts a bit. It doesn't really matter if they support NACS or CCS. Fewer EVs just means less charging demand overall in the near term.
Okay, that makes sense for infrastructure, fewer cars, less charging needed. What about the raw material side? Does a bad month for Tesla in Germany immediately hurt, say, lithium suppliers?
Often, yes, it can affect sentiment quite quickly, even if the direct tonnage impact isn't huge right away. You tend to see a reaction in the U.S.-listed materials companies leveraged to EVs. Think Albemarle, ALB, or Arcadium Lithium, ALTM. If investors see the leading EV brand struggling in Europe, they might take that as a sign of potentially weaker near-term global EV demand. That can lead to negative sentiment, worries about lithium pricing. That kind of macro interpretation often ripples through to commodity price expectations pretty fast.
But hang on, if we're saying the overall German market grew and Ford and Stellantis are picking up sales, aren't they still buying lithium too? Does it make sense for ALB or ALTM to drop if the total number of EVs sold is still going up, just made by different companies? Seems like an overreaction, maybe?
It absolutely can be an overreaction, you're right. But that's how market sentiment often works, especially with growth stories like EVs. These mining stocks are often priced for, almost perfect, continuous global EV growth led by the biggest names. When the most visible driver of that growth has a setback in a major market, the first reaction for many investors is to reduce risk. Sell first, then figure out later if Ford's or GM's gains fully offset Tesla's dip. It's about perceived deceleration.
Got it. The market reacts to the headline risk, even if the underlying demand shift is just between brands. Okay, last piece. What about the auto tech companies? Suppliers tied to EV platforms or advanced driving systems.
They can feel the sentiment pressure too. Look at Aptiv, APTV. Now, they supply everyone, traditional cars and EVs. Wide customer base. But headlines about an EV slowdown, even if regional and specific, can still put pressure on the multiples for suppliers seen as heavily leveraged to electrification trends. Same for someone like Luminar, LAZR. Their whole story is tied to the adoption curve of advanced tech, often going into premium EVs first. So if investors worry that the near-term EV growth trajectory in a place like Europe is cooling, even slightly, that can raise concerns about the timeline for widespread adoption of their tech. Really, the simplest way to think about it is, when the regional EV leader shows weakness, the market often tends to put downward pressure on the whole EV-related supply chain until there's more clarity that the issue is contained and not the start of a broader slowdown.
Okay, so we went from that one startling note, the 53.5% drop in German registrations for Tesla, and traced how that's creating winners and losers across different segments of U.S.-listed stocks, from legacy auto to EV challengers, charging networks, materials, and tech suppliers.
Exactly. And maybe the key thought to leave you with is how unique this situation is. Remember, overall BEV registrations in Germany were up in October. Tesla lost share specifically to competitors. That intense competitive pressure really raises questions, doesn't it? What does this mean for Tesla's pricing strategy going forward, not just in Europe, but maybe globally, as rivals show they can definitely capture that growing EV demand?
That is definitely something to think about. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.